ETFs versus individual stocks. Which one should you be choosing and why? So hopefully you guys enjoy the video. This is going to be more casual and laid back because there's no exact science to this, that's the truth. But I'm going to give you guys my thought process behind this. So you can see here how I have my thing set up. I've been investing for almost 7 years now, and this is what I settled on. So we can see here that 60% of my portfolio is made up of two of my favorite ETFs. And there's two reasons why I do this. The first one is diversification. ETFs are usually very diverse and they often follow some kind of index like SCHD. So mentally, that kind of covers my bases. And the reason why I bring up the whole mental aspect is because a huge portion of being successful in investing simply comes down to you and your ability to hold on to good assets during bad times. If you're constantly trading in and out of things, we all know the statistics. Day traders usually don't make money. So I would say your ability to hold on to valuable assets during market volatility is going to be the single biggest determinant in having the best returns versus just picking high quality stocks and ETFs, because if you can't hold on to them, it's all for nothing. So ETFs like SCHD are very well diversified and they cover my bases and follow an index. So I feel very safe and I can hold on to this ETF very easily. And then the second thing I like about ETFs can be represented by JEPI, and this is an enhanced dividend income ETF. So we can see they have a yield of almost 8% right now, and the way they do that is through equity-linked notes and selling call options and a few different strategies. And that's something that as an individual investor, I could do if I wanted to take the time to learn it and actively do that day in and day out, but I really don't want to do that. And ETFs like this automate that and give you that feature that you otherwise wouldn't have. So diversification and enhanced features / active management are the two main reasons why I like having ETFs. And then there are two major ways, just broadly speaking, that I evaluate my favorite dividend ETFs. The first is capital appreciation. Of course, that's not the major goal, but it has to be competitive, right? It just has to be semi-competitive. And when we add in the SP 500, in the light blue, we can see that both these ETFs are roughly in line when looking at the total return. So that includes reinvesting dividends. If we take that away and just look at the price appreciation, it looks a little bit different. Okay, so both of these ETFs have very competitive price appreciation. That's good, checks off the box. The next thing I look for, because these are dividend ETFs, I don't necessarily look at the dividend yield. I mean, of course I do, but that's not the major thing I look for in finding high quality ETFs. To me, the major thing that indicates high quality is the change in the dividend or the growth rate of the dividend. And if we come over here for SCHD, the annual payout growth year over year is displayed right here. And we can see that on average, the dividend payment increases roughly 9-10% every single year. And this is super powerful for having compounding and higher dividend payments, as well as just indicating quality. Quality companies are within this ETF. So broadly speaking, that's how I like to look at dividend ETFs. Now, when it comes to individual stocks, of course, I have a lot of individual stocks. The weighting is very little. And the way I view this is the individual stocks that I own are those that complement these ETFs very nicely, and also just companies that I wanted slightly more exposure to, because most of these companies are within these ETFs, but I just wanted more exposure to them because I think they're very high quality businesses. But on top of that, like I was saying, they have to complement these ETFs very well. And this is what I mean by that. So those two big factors of competitive price appreciation and dividend growth are what I'm going to be focusing on. This purple line is SCHD. And if you recall, Apple is one of the individual companies that I hold, and orange is the Apple price appreciation, and we can see that it's above the ETF. So that's kind of my baseline, my market index. So we can see how Apple complements SCHD very nicely by increasing the average, so to speak. Moving on, the next major thing was the growth of the dividend. SCHD, my baseline, had a dividend growth rate of around 10% year over year. AMT is another one of my individual holdings. It's a REIT. And when we come over here and look at the growth of their dividend, it is around 20% year over year. That's how much they're increasing their dividend every single year. And once again, we can see that this is above the baseline of SCHD. So this brings the average up. So that's basically how I go about doing this and choosing individual stocks versus ETFs and how I view them and how they work together. And of course, when picking individual stocks, there's a lot more that goes into it. I'm just focusing on stocks versus ETFs, but the quality of the business, all the Warren Buffett stuff, the moat, that's very important as well. So to summarize, I view my ETFs as a baseline. I choose the best one that I can that has solid price appreciation, dividend growth rate. They usually follow an index, so I feel very safe and covered with these ETFs, as well as some more complicated ETFs like JEPI that offer some kind of benefit from the active management. And then when it comes to individual stocks that I want more exposure to, they have to complement the ETFs very nicely and bring up the baseline. So they have to have better capital appreciation, a faster growing dividend, or just be a long-term play and have very promising futures. So hopefully you guys can understand the mental gymnastics behind all this, because I feel like this setup is very durable. No matter what market condition goes on, I'm not going to tweak it that much. I mean, of course, I might put down the target allocation a little bit, or maybe drop or add one holding, but it's not going to be a drastic change with this kind of a setup. And that's the major thing. You have to protect your portfolio from yourself and just buy good assets and hold on to them. And for me, this kind of a setup allows me to do that, but for you, it might be different. So hope you guys enjoyed the video. If you did, leave a like, subscribe, and I'll see you in the next one.